the next learning objective is going to focus on the main points of this chapter, and that is inventory valuation methods. Different inventory valuation methods, sometimes known as cost flow assumptions. Will vary in their results for the balance sheet and the income statement. They will not change cash flow, except when we bring in some tax issues, but the cost flow assumptions, and this is going to be under US GAAP, we're going to get back to all this. First in, first out. Last in, first out, and average cost. These are assumptions. Specific identification is another option. It's not an assumption. We'll talk about that. There's also and also we need to know is that LIFO cannot be used LIFO cannot be used under IFRS. Now, before we get to the specific methods, we're going to use something known as a periodic inventory system. Now, there are two ways that companies can track their inventory. One is perpetual, the other is periodic. Perpetual would get to an intermediate. We'll cover periodic in this course. Perpetual is much easier today because of what? Technology. A perpetual system means as soon as an item on a perpetual system, as soon as an item comes to my warehouse, I scan it, it goes into inventory. Somewhere in the country or around the world, when somebody buys that inventory, it's scanned out and it automatically reduces inventory, causes me to have cost of goods sold recorded. It's all done simultaneously. So periodic is a system that anyone can use. I mean perpetual rather. Perpetual is a system that anyone could use with technology. It allows you to record inventory immediately when it's received. When it's sold, it automatically reduces inventory and records your cost of goods sold and your gross profit. Periodic, however, is a system that is probably a little bit better to use when you're first learning inventory systems. This assumes that you don't have any idea what's in your inventory until you physically count it at the end of a period. So it's periodically determined, not every single day. So in here, you would have to get your cost of goods sold by this formula. This is needed for a periodic inventory system. It's beginning inventory plus purchases is your goods available for sale, minus your ending inventory would be your cost of goods sold. And this would only be done by physical count. Somebody would have to count the inventory, Beginning inventory is the ending inventory from last year. Then you would have to add the cost of what you purchased or produced. That tells you what's available. Ending inventory, when you count it, it's subtracted, and you get your cost of goods sold. So periodic inventory is not extremely practical today, but it is used quite often in valuation. And it is easier to understand these systems at the outset. We will get into the perpetual at some point. So periodic relies on this cost of goods sold formula. And just one note is extremely important. Just remember that these are cumulative accounts. And I noticed just by talking to some people, everyone's starting to get there, but there is generally a disconnect between your understanding of what is an income statement account and what's a balance sheet account and how they function. If there are balance sheet accounts, they're permanent, so the ending balance of one period becomes the beginning balance of the next. Something you have to keep in mind. Income statement, once they are at the end of the period, this cost of goods sold is closed out. And it goes to retained earnings. So ending inventory of one period becomes the beginning inventory of the next. Now, this is a diagram that I use in a little different way, but it's extremely useful for us. It's like a scale, and it kind of shows you that these have to balance. So beginning inventory plus purchases have to equal ending inventory and your cost of goods sold. Now, generally speaking, I mean, you know, if you look at the, let me just set this up for you a little bit differently. So let's take a look at the way I normally would put it over here. What I normally like to do is the same thing, but I'd rather look at it this way. I'm going to say beginning inventory plus purchases or production. So that's on one side. It's just the same diagram drawn differently. And when these two are added together, you get the cost of goods available for sale. What you have available could only go into two places. You either sold it or it's left over. So, one of two places. What you have available can either be left over or sold, one or the other. And that scale has to balance. Now, let me get this from color, let's use this. So let me give you an example of how, you're going to say, all right, well look, I mean, how hard could this be? Before I had Phelps Company buying goggles for, you know, $50 each. So, all right, I got 10 of them left, I guess they must be at 50. Not necessarily true, because what if you have a situation like this? And I'm going to complicate this even further later on in the chapter. But let's say your beginning inventory is 100 units at $2. And then you either produce or purchase a couple of others, 200 at 3 and 100 at 4. So your beginning inventory is $200. And you purchased $1,000 worth of inventory. So right now, it looks like you've got how many units? You've got 100 plus the 300 you bought here. So you got 400 units, and your total cost is $1,200. Okay, so now you still may not see a problem, but here's a problem. Unless you could specifically identify with barcodes the units in ending inventory, and let's assume you go out and you count ending inventory is 100. Let's say you wind up with the same 100 units. Hundred units are in ending inventory. 300 units are sold. So, unless you could specifically identify where those units came from, ending inventory, you counted them. Which units are they? Let's say you can't specifically identify, no barcodes. We're back in, the old days where you got stocks of items, boxes of inventory. What do you do? Is it the 100 that's left? Is it 100 at $4? Or do you have 50 at 4 and maybe 50 at 2? How do you know the unit prices that belong there?
Are they all the same variety of?
Yeah, but you bought them at different times.
Do you average them or give them an average?
That's one approach. You got an average cost approach. So that's one thing you can do. I mean, if they're really homogeneous items that would be something that maybe is not subject to obsolescence or spoilage, maybe an average cost is the way to go. Probably you would use an average cost. But if not, you got to make an assumption. So I might make an assumption and say, well, you know what? It's logical, especially if these items are perishable. I'm going to say first in, first out. So I'm going to say the 300 I sold came from where? 100 at 2, 200 at 3, and there's 100 left at $4. Now, that makes some sense for items that are perishable. When would you use LIFO? Does LIFO make any sense? When is the last one's in, the first one's out? There are cases where, and I'll talk about the justification later, there are cases where that may make some sense. Mining. If you were a Rutgers undergrad on this campus, you would have gone to the quarry in Roseland, the gypsum quarry, if you've taken geology, and usually go there on a really rainy day and people are sliding down hills and getting mud all over themselves. But in that quarry, they're going to be mining the gypsum. They use the gypsum to make sheetrock for wallboard and things like that. As they're mining it, they're piling it up on the top of a pile of gypsum. And when they use it, they don't use it from the bottom, they take it off from the top. So the last one's in and the first ones they use. So there are some applications. But generally speaking, LIFO doesn't make any sense for most companies. Because if you're selling a perishable item, anything subject to style change, right? Unless you want to sell it to me. So you're going to sell the oldest first. Okay? You're going to sell the oldest first. So obviously LIFO doesn't make sense, but if the LIFO method was used, you'd assume that you sold the last ones that came in, 100 at 4, and the other 200 at 3, and that would again be your cost of goods sold, and what's left, your beginning inventory. And we'll show you some numbers in a second. So these are the assumptions you make. But notice what happens. You're kind of taking that $1,200 and you're just kind of spinning it around, aren't you? You've got one method that gives you a higher inventory, another method gives you a lower inventory. So you're trading off. So you've got a fixed dollar amount that you're allocating to both statements. Did cash flow change? Not unless you bring in taxation. Without tax, there's no change in cash flow. Why? You paid $1,200 for that inventory, and that's not going to change by the method you use to allocate to the balance sheet and income statement. And we'll show you some numbers in a second. So, again, this is the model, although the model I use is a little bit different. It's the same idea. It's a scale that balances. All right, so let's go through, and these are U.S. cost flow assumptions, assuming that we don't have specific identification. All right, so first in, first out. First in, first out tells you that we assign the most recent cost ending inventory, the oldest cost to cost of goods sold. By the way, I have this later on, but this method was originally designed for companies that would be selling goods that are perishable, subject to style change, subject to obsolescence. It makes sense that you'd sell the first goods you get in first, and you'd sell your oldest units first. Then we have LIFO. And as I said, LIFO is assuming that the cost of goods sold are the most recent cost, but the ending inventory would be your oldest cost. Last one's in, first one's out. Now this, as I said, was originally justified by companies that were selling products in the order that I mentioned in mining operations. And even today, I mean, one of the nice things, and if you know, a lot of people want to go into financial services, and in my day in auditing, we did both. You know, I was in leasing and I did manufacturing because we were all generalists, which some firms still allow you to do to become a generalist. Now you kind of get into a specialty. So, you know, some of my clients were financial services, leasing companies, others were manufacturing. And one of the nice things about manufacturing is you get to see the process. You get to see how this works, how these goods are manufactured. And, you know, you go through a warehouse and you walk through, and as they're using parts, as they're taking component parts, those parts could be, you know, items that made out of metal. They're not going to rust. They're not going to, you know, become obsolete. And, you know, you're just pulling items out of these bins, and in the back of the bin, there's like a little red tag that says reorder. So kind of very rudimentary, but it's still used today if the last one's in and the first one's to be sold. You know, the gypsum example is a perfect example of how companies would use that. By the way, how do you take inventory of something like that? How would you take inventory of a pile of block? Weight now, but you're not going to pick it up and reweigh it, right? Anyone think of a way to do that? Well, the way we did it was we hired an airplane, a little bit of propeller plane, with a photographer and a mathematician. Took pictures of the piles and had someone figure out geometrically how much was there. And that's the way we took the inventory on that. So it's pretty fast. I mean, auditing is, I mean, aside from the late hours, and you can get some pretty fascinating results here.
So when you hired that plane, that's the cost of inventory, or is that?
No, that's actually the cost of all. We billed the client, but it was my auditing. You know, I forget whether I was with Coopers or with KPMG at the time, but yeah, it's part of our cost of auditing, just like paying your travel.
Okay.
I mean, of course, you discuss it with the client. You've got to be able to come up with a way to count that or to measure the amount that's there. Okay. All right, and finally, Drew, you mentioned average cost. And the average cost makes a lot of sense if you're selling a product that is really homogeneous, and it's very hard to distinguish one unit from another. Like fuel oil, natural gas. I mean, what do you do if you get a tanker that pulls up to your Shell station and, you know, adds more to the existing balance of the fuel that you have? You know, fuel prices go up. I guess you got to get there Thursday night or something before they change them on Friday or something like that. You know, so the prices will fluctuate, and therefore, when you get that shipment, you really can't tell what is in that. So you use an average cost. Average cost is very simple. Average cost, by the way, is probably also used for, you know, supplies inventory, and it's used very, very often. So the average costing method would be used. But here is the key. Those are the original intended uses. We can get all those original intended uses. They're gone. Today it's driven by management's intention to report income in a certain way and taxes. The inventory physical flow does not match the cost flow. Give you an example. As far as I remember, Kellogg's uses LIFO. The New York Times uses LIFO. So does that actually mean that if they have newspapers left over today, they leave them in inventory and they just keep piling them up? Does that mean that boxes of cornflakes kind of just sit there for years? What it is a system that you have to understand that units that we sell The physical flow is logical. The cost flow may be counterintuitive. So we're going to sell the oldest boxes of cornflakes first, but we might be using a price that maybe didn't exist on the day we manufactured that box of cornflakes. So we might use LIFO to value inventory. Honda uses LIFO. Or I should say, no, excuse me, Honda uses FIFO. Other car manufacturers, US manufacturers, use LIFO. Last in, first out. So that's basically saying that Ford and General Motors would be selling cars that they just made today, but not sell cars they had in inventory from last year. It's not true. They sell their oldest cars first, but it's the unit cost they assign to those units that they've sold. So the cost flow may not follow logically the unit flow. Okay, so let's go through some examples. Now we're back to our friend Phillips, and basically saying to us that they had 100 goggles in inventory costing $4 each, and we're going to use FIFO. So let's put it on the. Now I'm going to give you a more complicated, not very difficult, but more complicated than this. So we start with a beginning inventory of 100 units at $4. And then we go out and we buy 400 units at $4.50. And in this case, we wind up with 500 units at a total cost of $2,200. And they said they sold 460 units. So if they sold 460 units and you had 500, then 40 units have to be in any inventory. All right, so if we're using FIFO, first one's in, first one's out, oldest cost to the cost of goods sold, the most recent cost to ending inventory. The most recent cost in ending inventory would be $450. And the oldest cost would be a combination, obviously, of the two. So let's see how that would work. So here's our cost of goods sold. Under FIFO, you sold 460. The assumption is that you sold 100 at 4, and then another 360 at 450. So that's your assumption. So our assumption here is that our cost of goods sold is going to be $2,020. And the ending inventory is the most recent cost. You've got 40 units left at $450. And that's going to be at $180. Now, a couple of things to notice. The scaled balances. 400 plus 18 is what? 22. And 180 plus 2020 is 22. So it's an allocation process, and in fact, let me kind of list that right here. If I'm using FIFO, give us a scoreboard, it tells us that out of the total amount available, the income statement is going to be charged for 2020, and the inventory is going to be on the balance sheet at 180. Now, I'm going to ask questions in a second, but first, let me do one other for comparison. And let's do the LIFO basis. Same thing. Start with 100 units at 400. You buy 400 or produce 400 at 450, that's 1,800. 500 units available at 2,200. You got 460 sold, you got 40 left. What cost do you assign to the units in ending inventory and the units that are sold. And by the way, one of the other things you got to be very careful, that's the selling price. That's the revenue. It doesn't affect us in the inventory valuation right now, unless we were doing a cost of goods sold. So, under this case, we're going to wind up with the following. We're going to assume that the cost of goods sold is going to be the most recent cost, then the next most recent. So the most recent cost, the newest cost, is $4.50. So we assign 400 units at $4.50, and the other 60 come out at $4. So the cost of goods sold is $24. Now, the ending inventory, by the way, if you're in an exam scenario and you're very confident, you should realize that if I said, give me the ending inventory and the cost of goods sold, if you got the cost of goods sold, you know that you've got a total of $2,200 to work with. If 2040 is your income statement, balance sheet's got to be 160. But the way to get the 160 is to tell you that it's coming out of the beginning inventory. You got 40 units left at 4. So when you look at the LIFO approach, cost of goods sold, again, it has to add up to 2,200. Cost of goods sold is 2,040, and ending inventory is 160. All right, so let's make sure that you understand the approach. If it's first in, first out, cost of goods sold comes out of beginning inventory first, then purchases. If it's last in, first out, it assumes that they come out of the newest first, and then the oldest. It's the most recent. Ending inventory is your oldest cost. Now, here's the real catch. If this company is selling goggles that I assume that will go out of style, maybe they'll change the colors, the neon, the materials, whatever, the neon colors, the materials. Look, this company is going to sell their oldest units first. And physically, that's what they're doing. That's what they're doing. They're just assigning a new cost to old units. They're assigning a new unit cost to old units. Another example, let's take Ford, selling cars on a LIFO basis. They will simply take their oldest vehicle, sell that car to you, but they're going to assign the cost of the car they just produced today. The car they sold you, they could have produced 8 months ago. But they're going to assign the cost of a vehicle they produced right now. So the newest cost gets assigned to their cost of goods sold. And in that way, and if you look at the results in terms of a period of rising prices, what does LIFO do to cost of goods sold? Increases it. What does LIFO do to ending inventory? It reduces it. So, two things to note. Number one is if I was thinking about matching, now again, the objectives, my income statement objective, direct association, cost of goods sold with revenue. If Ford is selling vehicles and prices are going up, do I better match with more recent cost or older cost to get my gross profit? What would give me a more faithful representation in the sense of my gross profit? Costs are going up as well as selling prices. Gross profit is measured under LIFO by taking the current selling price but also using the current cost of production. Is that a better income statement matching than using an older cost? Right. The LIFO better matches the income statement. In fact, if forgetting about depreciation for a moment, if you look at all of your income statement expenses, think about all your income statement expenses. Salaries, utilities, they're all current costs. So you might as well have your inventory at a current cost of goods sold as well. Now, why would, I don't know if Ford or General Motors are all that concerned about matching costs with revenue, although they do meet the income statement objective. And notice that they understate the inventory, so they kind of trade off the balance sheet objective. But there's also another important point. The reason why LIFO is so popular in the United States, and companies like Ford, General Motors, Kellogg's, I mean, you name these companies, they make no sense logically. And that's why LIFO cannot be used under IFRS. It's completely senseless to use LIFO. It's not what you're really doing. But in the United States, there's an Internal Revenue Service LIFO conformity. And you'll see it in the text. So in the United States, and I know you studied for the exam, and you realize that the FASB is in fact quasi-independent from the government. This is one of the few cases where the government dictates policy. They tell companies, look, you want to use LIFO for tax, you have to use it on your financials. You have to conform. Now, why would you want to use LIFO on your financials? Higher cost of goods sold, matching, but why would you want to use it for tax? Higher cost of goods sold reduces tax, and that's when you get your cash flow benefit. So you get a cash flow benefit from using LIFO because you reduce your taxes. Taxes are going to be reduced. And that's why it's so popular in the United States. Now, there are a lot of things that happen when you use LIFO. We'll talk about it. That might be costly, and you have to weigh out the tax benefits. Now, what about the balance sheet objective? Well, we believe that FIFO gives us a better balance sheet. I'm going to do this all again when we do our next example, but FIFO gives you a better balance sheet. Why? It is measuring inventory at a value that's close to current cost. It's close to its replacement cost. So if my ending inventory of the goggles in ending inventory, going back to FIFO for a minute, I have 40 goggles at $450, that's close to the cost I'm going to have to pay to replace them, correct? So the inventory on the balance sheet, from a user's perspective, a financial analyst, they're going to see the inventory that's valued at an amount that they could reasonably expect to get if they sold that inventory. And you have to think about the applications, like in mergers and acquisitions. If I want to buy your company, I'm going to value your assets. I'm looking at inventory, and if I see the inventory at LIFO, I know it's understated. And we've got some disclosures to help you. But if I see it under the FIFO basis, I know it's as close as possible to current cost. And if I buy your company and I take that inventory, that's the value we get. Okay, now, one last point, and that last point is, if you look at the inventory under FIFO versus LIFO, and you think about the economic valuation there, and you think about the benefits of using LIFO for tax, what industries do you think would not benefit from LIFO? Well, what do you need for LIFO to be tax beneficial? There are a couple of things, but one of them is what? Rising prices. If inventory costs are not going up, in other words, if this was reversed and I use LIFO, my cost of goods sold would be primarily at what? $4. So if prices go down, LIFO backfires for tax purposes. So if prices are declining, I probably wouldn't use LIFO. What industries do you think would not use LIFO?
Technology.
Yeah, exactly. Yeah, technology companies are going to be on the FIFO basis because their prices tend to decline. So there are industries that will use LIFO, others would use FIFO. And by the way, even if, because you have such multinational corporations, even if your company uses LIFO in the United States, their foreign subs will be using FIFO or average. They can't use LIFO internationally. So you find companies with combinations. So it's not always drawn up that neatly on industry lines. All right, so to summarize this, just remember again, it's the real issue is when cost of inventory will change over time. Now I'm just going to do average cost, and we'll take like a quick 2-minute stretch. So let me get to the average cost with you, and then of course we'll summarize. So average cost, again, same information we had before. So you've got company buying 100 goggles at $4 each in June, and I'm sorry, started the year, excuse me, with 100 at $4. They go out and buy 400 at $4.50, and they sold the $4.60. Now the average cost, the way to look at average cost per unit is to take the total cost of goods available over the number of units available. And in this case, the total cost of goods available is what, 22? Total number of units is 5. The average cost per unit is $4.40. Now, it is a weighted average, and what are the weights? The number of units in each batch or each level. So it's a very simple weighted average. And how do I know the weighted average is working? Because 440 results because the weights are heavily on what? The purchase at 450. Well, you got more units in the 450 batch than you do in the $4 batch. So there's more weight, and the reason why I say that is after the quick stretch or break, whatever you'd like to call it, we're going to do a more complicated example, and you'll see very easily how those weights play out. But again, to do a logic check, like if you got an answer, for example, if this average cost came out to be, $3.90, I would like you to look at the answer and realize that it's wrong. Right? It can't be. I mean, obviously. So, you might make a mistake. You might use the HP calculator without knowing how to use it. Right now, we'll get there. So, again, the weights make sense to me because you got more units at $4.50 than you do at $4. So, in this case, the calculation is that the units sold would be 460 units at $4.40, 2024, and cost of goods sold, 40 units at $4.40, and it's 176. So if we go over to the scoreboard, and I put in the average cost here, $20.24 and 176, it should make sense also that the average falls where? In between. In between the two extreme methods. So that's another way to check what you're doing. I mean, what we need is sometimes when the computations get a lot more complex, we need logic checks, we need reality checks, sanity checks, whatever you'd like to call them. So you're doing an average cost, it better fall between the two. It's got to fall between LIFO and the FIFO costs. All right, so again, to summarize, and this is also on the next slide with your scoreboard, it gives you the amounts. And again, we tell you that in periods of rising prices, LIFO gives you the highest cost of goods sold. That's the tax benefit. And by the way, that's the only place where cash flow comes in. If you use the same method for book and tax, there's no real cash flow difference because you paid $2,200 for this inventory, between the two periods. So the only cash flow effect comes in when you have your taxes, and the taxes play an important role in this. All right, so if you take a look at slide number 30, this is a more extensive example. Notice that you've got prices rising so that it is a period of inflation or rising prices for this company, which would make LIFO tax beneficial. So we start the year with 1,000 units at $2. We have a series of purchases or production that give us another 15,000 units at a total cost of $58,000. 2,000 beginning, 58,000 purchased. Your goods available for sale are equal to 16,000 units at a total cost of $60,000. Because this is assumed to be a periodic inventory system, inventory is counted, and we have 5,500 units. That means, of course, if we had 16 available and 55 were in any inventory, then 10.5 is available. 10.5 had to be sold. So the question is, if I can't use specific identification, or I don't want to use specific identification, how do I allocate the total cost of $60,000 to the 10,500 units sold and the 5,500 in ending inventory? Well, in the United States, we're going to apply 3 cost flow assumptions. Under IFRS, you'd have 2. Under US GAAP, we'd apply LIFO, FIFO, weighted average. Under IFRS, only FIFO and weighted average would be, and of course, specific identification if it was possible. Here's another way to look at this inventory allocation question, and this is using the cost of goods sold formula that is needed for the periodic inventory system. You got beginning inventory plus the cost of goods purchased, gives us goods available, and again, we've got the $60,000 that we need to allocate to ending inventory and cost of goods sold. So this is a question mark which depends on the inventory cost flow assumption we made. Now again, if the prices were constant over time, if the units were always at $4 or always at $3, there'd be no inventory allocation problem. If I was able to use specific identification, there'd be no inventory allocation problem. So in this case, and again, specific identification we can use really today in almost any online inventory system. But again, it may not be what management wants to achieve from its inventory accounting. So we will look at these cost flow assumptions, as we said, FIFO, LIFO, and average cost. Okay. So once again, here is the illustration. And this illustration again is the broken down into pieces. So the question then becomes, the $5,500 in 5,500 units in ending inventory, where are they coming from? If you're using a first in, first out approach, then the ending inventory will be the most recent, right? The first one's in and the first one's out, ending inventory would be the most recent cost. If it's LIFO, ending inventory will be the oldest cost. Either way, if you want to calculate the ending inventory, you're going to go up, so I'm going to erase this in a second. FIFO, ending inventory, you would get the most recent cost, the next most recent cost, and so on. For LIFO, FIFO ending inventory is the oldest cost, the next oldest cost, and so on. And again, the unit flow does not have to equal the cost flow. So the way the units actually leave the company doesn't have to match the way we assign these costs. So you can pick, and I'm going to show you a couple of different ways to do it. You can find, your best way to handle this. Typically, and I'm talking, maybe 30, 40 years ago, you'd always teach this as valuing ending inventory and backing into cost of goods sold. Why? Ending inventory usually is lower. You have fewer units to value, right? But it's up to you. You could do it either way. So let's now take a look at our alternatives. So in the first case, I want to do average cost. And the average cost is a weighted average periodic method. Again, the original use, firms selling a very high volume of a homogeneous product like oil and gas. The average, and I have it right below the screen, is the total cost of goods available for sale divided by the total number of units. In this example, the total cost of goods available was 60, and the number of units is 16. Going back, cost of goods available is 60, and number of units is 60. Now, the average cost, my guess is the average cost is going to fall. The weights obviously are higher on the $3 and the $4 amounts, right? Those are the highest weights. So we would expect that our average cost should be somewhere in the $3 to $4 range. And that's exactly what we see, is that it's $3.75. Because the weights are the number of units in each batch. The more units you buy at $4, the more likely it is the average will be like closer to $4. Now, the ending inventory is 5,500 units at $3.75, or $20,625. Cost of goods sold, you could back into it, goods available for sale minus ending inventory, or you could take the number of units you sold, which is 10.5 at $3.75. So again, it's entirely up to you which way you want to handle this. By the way, if you get cost of goods sold, you could always back into ending inventory. So it's again, that scale is important to kind of visualize that it's always going to balance out, always going to balance out. So in this case, let me just put a number up here for you. In the average cost, $26.25 is the, cost of goods sold first. So the cost of goods sold is $39,375, and the ending inventory is the $20,625. All right, so now, before we leave this example, any questions about the average cost? Any questions about the average cost? So remember, and by the way, again, I know I keep repeating that, but you're allocating a fixed amount. So you're allocating that 60,000 between units on hand and units that you've sold. Well, let's go to the next. First in, first out, or FIFO. This assigns the most recent cost to ending inventory, the oldest cost to the cost of goods sold. And we said that, again, companies that are subject to style change, spoilage, technological changes would use the FIFO basis. Now, before we go to the calculation, let me go back to the original data. And it depends on how I want to do this. I want to calculate ending inventory first. So I've got 5,500 units. So if I go up the table, if the first one's in and the first one's to be sold, then the oldest units are sold first. The newest units are on ending inventory. So I've got 3,000 at 5. I then need 5,500, so I have another 2,000 at 450. That gives me a total of 5,000, and then 500 at 4. So if I look at the calculation, again right here, I'm going to have the most recent cost 3,005, the next most recent, 2,450, and then the next most recent, 504. You keep counting up the table until you get 5,500 units at a total cost of 26. If, of course, I'm confident enough, I take my goods available, subtract the ending inventory, and get the cost of goods sold at 34. So FIFO, 34 on the cost of goods sold, ending inventory is 26. And of course, the total is 60,000 that I've allocated. If you wanted to, if you prefer to calculate the cost of goods sold, the way the method is kind of entitled, first in, first out, you can always do it this way. You could say first in, first out. How many units did I sell? I sold 10.5. Start at the top, 1,000 at 2, 6 at 3, that's 7,000 units, and I need another 3,500 at 4. So I can always do it that way as well. And that's what you see on the bottom of the screen. Now, one of my professors at NYU always told me that you should call FIFO LISH, last in, still here, and LIFO fish, first in, still here. But I don't know which one works for you better, but as long as you can calculate it, you've got it. All right. Last in, first out. Last in, first out assigns the oldest costs in the inventory, most recent, the cost of goods sold. As we said, its original intention was to accommodate companies that had a base stock inventory that would be used by consuming the most recent first. But the ending inventory is the oldest here. So you go back to the table, beginning inventory was 1,000 units at 2. The next batch, now let's show you where that's coming from again. The next batch, March 30th, had 6,000 units at $3. So if you wanted to get ending inventory, it's the oldest, 1,000 at 2, 45 at 3. And that makes up the balance you need for the 5,500. So under LIFO, the ending inventory is 15.5. And of course, the cost of goods sold, because this has to equal 60, you know it's got to be the difference. Or if you wanted to, you could count up the table and calculate the cost of goods sold. Cost of goods sold is the most recent. So you would have 3,000 units sold at 5, 2,000 at 450, and so on. If you wanted to go back, I'm going to show you that one more time. So if you wanted to do it this way, if you wanted to say last in, first out, 3,000 at 5, 2,000 at 450, 4,000 at 4, so that's what, 5, 9, and 1,500 at 3, that would give you the cost of goods sold. If you counted up the table, the most recent. Now, either way, whatever you feel comfortable with is correct. All right, so, and again, the LIFO conformity rule, use it for financial statements, you have to use it for tax purposes. And by the way, that's not, it's kind of silly in a way, because if you think about the intent, and I'm going to, I don't think we'll get to it today, but there are disclosures that enable you to convert a LIFO company to FIFO. But the original intent here by the IRS was to say the following. Look, we don't like the idea if you show your stockholders a very low cost of goods sold, but then you're going ahead and deducting all of this on your tax return. Now, why they picked LIFO, I don't know. I mean, there are other methods that you can use and understate your taxable income, or not understate, but reduce taxable income, and still show a higher number to your stockholders. For some reason, LIFO was being used very, very frequently. Companies were taking advantage. So they thought this might be a way to slow up the use of LIFO. But if you're a financial analyst that's reasonably informed and you see a company uses the LIFO method, I think you understand that the company is showing a higher cost of goods sold and understating its ending inventory. Right? I mean, that's something you would know. And as I said, this is something that you might want to think about as one of those measurement systems. You know, instead of measuring using meters, we use feet, the British system. Same idea. It's the same inventory. It's the same purchases. It's the same sales. How does it come out to be different? A different measurement system, different valuation system. So, and again, you notice that the average cost falls between the two extreme numbers. And if I had to, let me give you the summary, if I had to look at the objectives, you know, we got this classic trade-off here. The balance sheet and income statement effects of LIFO versus FIFO. You know, again, LIFO significantly understates inventory. So if I'm looking to satisfy a balance sheet objective, which again is valuing inventory, I'm sorry. Here's your inventory. So if I wanted to satisfy the balance sheet objective to show an inventory that's as close as possible to current replacement cost, I'd want to see FIFO on my balance sheet. So this better measures inventory. So that inventory is carried at a value that approximates replacement cost. It approximates the replacement cost. On the other hand, if I was thinking about matching and satisfying an income statement objective, I would use LIFO. So I've got better matching with, again, costs are going up, right? So you've got inflated sales dollars. A higher cost of goods sold gives you a better measure of gross profit. So think about, I mean, obviously, if unit costs are going up, your selling prices are going up too. So it doesn't make any sense. If you look at the FIFO basis, they're charging old dollars against inflated selling prices. So their gross profit is overstated. So FIFO gross profit is overstated. They call that phantom profits sometimes in ending inventory. So again, the balance sheet objective, yeah, if I want to look at my balance sheet with an inventory value that's as close as possible to replacement cost, I want to use FIFO. However, if I want to better match cost with revenue, if I want to look at the ability to save taxes, I would use the LIFO basis under US GAAP. Now, one of the good things about LIFO, after a while, the SEC realized that companies might need to analyze your financial statements in a little bit better way. So if you use LIFO, you provide disclosures which help an analyst to convert LIFO back to FIFO. So we do get the best of both. So a LIFO company discloses what is known as a LIFO reserve, which is the difference between the two. And you could take that, just add it back, and get your FIFO inventory. And we'll show you that in some parts of this chapter as well. Yeah.
Like if I was a shareholder, like an activist investor, can I tell a company to like convert it backwards? Like do shareholders have any to go from like LIFO to FIFO?
Yeah, you can change your method. If you change your method, you can't do it every year, and it has to be justified.
But it's not just something controlled by internally by the company.
Well, no, it is. Inventory methods, but they have to be disclosed. So I would have to tell you what the change was and what the effect on net income was. All right. All right, so again, think about, and again, this is one of the questions we had today. We did it for receivables. Could do it, I could write that same question for inventory. There are always trade-offs of objectives. Methods will focus on one statement and trade off the other. And you'll see, this is going to be repetitive. I mean, you'll see this until next August. Every method you look at is going to either have a balance sheet focus or an income statement focus. And as I said yesterday in the review, a lot of the newer GAAP standards are focusing more on the balance sheet. And the income statement is becoming a little bit more volatile. In other words, years ago, maybe about 15 years ago, the FASB and the SEC were focused on income smoothing. They wanted methods that would produce a very predictable trend of earnings to avoid any volatility in the stock market. And now we've swung the other way. Now we're saying, well, you know what? I think we better come up with a more reasonable balance sheet valuation. Now, this doesn't apply to inventory because we've got this tax issue, but the newer items are coming, the newer standards are coming to us in a balance sheet emphasis or balance sheet focus. Okay. All right, again, we said that average cost falls in between, and this just explains, again, the trade-off between the objectives. And it does tell you that, and we will look at these ratios. I'm going to look at this inventory turnover ratio, but LIFO biases ratios. The first thing you'll notice is working capital. If I'm using LIFO, my working capital is understated if I use LIFO. And this is where a financial analyst would pick this up. So if I'm comparing my company to yours, and your company's predominantly on LIFO, mine predominantly on first in, first out, or average cost, if your working capital is lower than mine, I have to adjust for that. Because I understand that LIFO understates inventory. And we'll talk to you a little bit more about the turnover ratio. What I'm going to do is I'm going to bring in some other ratios from receivables as well in measuring the operating cycle at the end of this chapter. Now, just a couple of notes, or I guess warnings. If you use LIFO, and the rankings and relationships only hold if prices are rising and inventory levels are constant or increasing. If prices decline, I think you understand that LIFO benefits are reversed and FIFO becomes more beneficial. Well, what about declining inventory? So let's go back to our base example. Okay. So what would happen if I sold 5,500 units and I have only 2 purchases this time, and I make those 2 purchases on March 30th and April 16th. And let's assume that, again, I have 11,000 units available. Let's say I sell 10.5, and of course I have 500 left. We're going to change this. When I look at LIFO, what happens to cost of goods sold? If inventory levels start to shrink, where are these 10.5 coming from? $4, $3, and I've got to eat back into this later. So I'm going to have to release old costs. Inventory levels are shrinking because inventory went from what? 1,000 to 500 units that are left. So inventory goes from 1,000 units down to 500. Inventory is shrinking. That means I have to do what? Start to release those old unit costs. And what happens to cost of goods sold? It goes down, profit goes up, and so does what? Tax. So when inventory levels start to decline, so you went from 1,000 to 500. When inventory levels start to decline, you wind up having to sell off old layers of inventory cost. Now, not the units, but the old layers. Now, today it's not quite as bad because you'll learn about efficiencies, that they have just-in-time inventory. For example, companies don't want to carry a lot of inventory, and they receive it just in time for production. So that has occurred already. But I will tell you that when I was auditing, we had LIFO layers that went back, without exaggeration, 5 to 8 years. We had costs that were sitting there 5 to 8 years old because inventory would increase a little bit every year. Now, that was all to get tax benefits. Now, does that make any sense? In fact, by the way, if I wanted to avoid, this is known when inventory levels decline. It's called a LIFO liquidation. How do I avoid a liquidation? All right, so you're managing this company, and you're sitting around on, at the end of the year, not quite December 31st, and you see inventory levels dropped by 500 units. How could you avoid the liquidation? Can you?
Purchase more units.
Just buy more, produce more, or buy more units. Now, this is why in IFRS, this is kind of illegal in a way, or nonsensical in a way, because now your management is trying to make sure that they capture tax benefits. And what might happen? If you overbuy the inventory just to avoid the liquidation, what might happen?
Wouldn't the problem get worse later on?
Yeah, not because now you're carrying more inventory. What makes it worse is inventory's got to be stored, it has to be insured, it has to be handled. Your inventory holding costs go up. So the argument against LIFO is that it makes managers sometimes come to decisions that are not all that efficient. So you can avoid a liquidation just by manufacturing more units or buying more units at the end of the year. So more storage, more insurance, and potential obsolescence is the other problem. So a LIFO liquidation is something that, again, we have to deal with sometimes, and it will lower cost of goods sold because it's going to force you to eat back into these older layers of inventory. In fact, let me just show you what happens. Go a little further here. A LIFO example. In our LIFO example that we see here, notice that if next year, if I don't buy any inventory, I'm already selling them at $3. Right? If I don't buy or produce any inventory, I'm selling. And this is why companies that use LIFO, I don't think like to use a straight LIFO approach in intermediate. We're going to talk about dollar value LIFO and different LIFO approaches that could help us avoid this. But using straight LIFO right now, if you look at that inventory is the ending inventory of the year of my example, but it's the beginning inventory of next year. If I used a perpetual system and I sell a unit on January 2nd, that would have to be costed at what value? It's got to come out of the $3 layer, right? So if I don't buy anything and sell my first units perpetually, that's why a periodic system is preferred in many ways, or dollar value LIFO. Because if you have a periodic system, what could you do? You could wait. I want you to see this clearly. You wait until the end of the year. And out of those 10,500 units, you're saying that you're going to be using costs that did not exist when the actual sales took place. All right, what if you sold something up between January 1st and March 30th? You're going to value that cost of goods sold at partially at $5, $4.50. Those costs didn't even exist on the day you sold those units. So this is another argument against LIFO. It is completely unrealistic on a periodic basis.